Morning's Money Watch, we want to show you why the Federal Reserve is important. President Trump on Friday announced Kevin Warsh as his nominee to lead the central bank after current Fed Chairman Jerome Powell. His term is going to end in May. Warsh is a financier, a bank executive who was a member of the Fed's Board of Governors during the 2008 financial crisis. Now, the Senate, of course, will still need to confirm him, but Warsh's nomination follows the Fed's decision to hold interest rates steady this month. So I am so happy to say that CBS News business analyst Jill is here to explain what that means and just the whole piece of what the Fed does. So let's start with the decision, right? I mean, this was expected that they were going to hold it steady.
Yes.
What does that mean?
I mean, it means that if you are a borrower and you've got a credit card balance or you're going out to get an auto loan or you've got a personal loan, it's still very expensive. I mean, credit card interest rates for those balances, they're averaging over 19%. That means that a lot of people are paying in the 20s. Auto loans, really expensive. It depends on your credit score. If you have a shaky credit score, you can pay in the teens, 14, 15, 16% for an auto loan. So when we say that the Fed has not lowered interest rates, it really does directly impact people. Now, the good news is if you are a saver, if you're lucky enough to have some money in the bank or a high-yield savings account.
This is good news for you.
It's great. You're saying, oh, I can get a nice, juicy CD. Maybe it's 3.5% or 4%. But, you know, as much as our eyes all glaze over when we say the words Federal Reserve, it really impacts every single one of us.
Well, you and our eyes never glaze over because we nerd out about this stuff. I do want to hit on mortgage rates quickly, though, because I think people say, oh, if the Fed moves or stays, does that mean that my mortgage rate that I want to get for my house is going to be better?
Well, the problem with the Fed is they control short-term interest rates, whereas mortgages are based on longer-term bond yields and interest rates there. Now, look, if you go back a year and we say, hey, 30-year fixed-rate mortgages, they were averaging around 7%. Now they're around 6%. So the idea that the Fed was lowering interest rates throughout last year did help bring down mortgage interest rates. But it's not tick for tick. It doesn't say, it's not like you get a mortgage, you say, oh, the Fed lowered interest rates, now my mortgage is 0.25 percentage points lower.
Right.
So the issue around mortgage rates really has to do with the supply and the demand and where people think interest rates and inflation will be in the future.
And because of that, because we know that the Fed is probably going to, stay on a wait-and-see approach, you're likely not going to see mortgage rates move as much because of that sort of where things are going to go.
Yeah, a lot of people have been asking me, should I refinance? What do you think? And it's impossible to know. So I think it's very dangerous to try to guess where the next quarter of a percentage point move is going to come from the Fed. Hey, maybe the Fed is going to lower interest rates. Maybe Governor Warsh, the Fed, when he becomes
if he is confirmed,
that maybe he's going to be the guy to get everybody on board with pushing down interest rates. But he is just one vote, and the voting members of the Federal Reserve each have equal weight. So it's not as if he gets installed and then, poof, he can just make interest rates go down.
Right. That is what the president is hoping, of course, is going to have happen. I do want to get at this question of independence, right? We know that the Fed focuses on inflation, focuses on the job market. We talked about how all of this impacts consumers just now. Why is it so important that the Fed remains independent?
I want to be clear that every president for the more than 100 years that the Federal Reserve has existed likes to pressure the Fed either overtly or covertly, meaning they might go behind the scenes saying, it would be nice if you lowered interest rates. Why is that? Because when you see interest rates go down, it is good for borrowers, and it can kind of juice up the economy. The problem is if there is real pressure on the Federal Reserve to lower interest rates, and that causes inflation to resume higher.
As we've seen in other countries like Argentina.
Yes, and we have seen in other countries like Turkey more recently, that if you see that happen, it's very difficult to get it under control once it starts. So while the president who is seated right now wants lower interest rates, if that causes inflation to rise in a year or 2 years from now, the next president, the next Federal Reserve is going to have to combat those interest rates. And look, we just went through a big inflationary problem. We know how much it hurts. I don't think that Mr. Warsh wants to oversee a Federal Reserve that sees the resumption of higher inflation. So we'll wait and see. We'll make our judgments. But for right now, as you said, wait and see for the Fed.
And just really quickly, Warsh, right? He was just nominated. What are you hearing? Are people liking this? Are they concerned about independence?
I think that Wall Street likes it. I think that people feel that he has enough of an institutional background. As we said, he served from 2006 to 2011, that he doesn't want to tank the economy and see that inflation takes off. But in the end, I think he is a guy who will be responsible. We hope for that because we need the Fed to be responsible to foster economic growth and contain inflation.
It sounds like we're talking to similar people because that's what I'm hearing as well. That, you know, maybe in the future interest rates goes down in the short term, but that he's someone that would be credible, they hope, for the long term.
Indeed.
All right, Jill, so good to chat with you.
Always. Two financial nerds hanging out.
All right, thank you so much. And if you have a question about your financial life, send an email to askjill@cbs.com. I promise you, she is fabulous. She could answer it during an upcoming event. And you can hear more advice on her podcast, Money Watch with Jill Schlesinger. New episodes drop every Saturday and Sunday.